It's been said before, you want to go fast, go alone. You want to go far, go with a team. What's up, everyone? Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And I'm here each and every week to share knowledge and insights from what I've learned in nearly 20 years as a financial advisor. And I'm here always reminding you that your money matters. And when we talk about staying invested, which we're going to talk about today, how hard is it to do that during times like this? From 2020 to 2022, I've been talking about this very heavily. Everything we've seen from inflation to supply chain to the conflict overseas to the recent conversations we've been having lately around recession here on the show and with our clients here at One Capital Management. But the question I keep hearing really comes around this topic of, hey, Brad, should I really stay invested? Look, Brad, I've heard you. I understand. I get the discipline. I get the discernment. I get all that. And I get that you're actively managing it, yada, yada, yada. But should I stay invested and ride out these volatile times? Anyone watching or listening right now, if the market's ups and downs of 2022 have you feeling a little queasy or sick, know this, you're not alone. I talk with so many people each week during review meetings, virtual meetings, or dinner events. This is a common theme for this year for everybody. It's very understandable. That's the first thing I want to say on today's show. It's very easy for our brains to tell us it's okay to stay invested and to listen to someone like me during a year like 2021. Not a big deal. So during the ups and downs, like this year, it's probably the best time to take a temperature gauge on where we're at on our entire financial picture. You hear me often say this, and here at One Capital Management, we preach this a lot around the conversation and the topic of holistic planning, meaning taking a look at everything around your entire financial life's picture, not just one area like a stock or something like that. Remember this, growth without a plan isn't really growth at all, because that can be eroded just as easily as it can be gained. Understanding what planning and attaching goals and obtaining those goals and not getting stuck up in a number or wanting that number to keep growing and just continue growing, but know how it is going to fit into that growth is going to fit into your plan in your overall financial and retirement context. And that's why I want to talk today specifically on the Make Your Money Matter show about staying the course during these volatile times. But before I jump in, be sure to smash the subscribe button and hit the notification bell so you don't miss a single episode. All right, let's get into it. Volatility and uncertainty, they go hand in hand, right? I think we all can agree with that. One of the most common questions I've been getting is, which makes total sense right now, is should we stay invested and ride out this wave of uncertainty? And it's a question that almost all investors, no matter what the ages are or span the spectrum of wealth, have. And so for you watching and listening right now, we're going to go through that. Now, real quickly, my son Brooks is going into first grade. So for any parents out there, or grandparents, having this conversation as you kind of go from pre-K and kindergarten into first grade, there's different things that we talk to them about as we go into this stage. Like, for example, I'm teaching him right now how to tie his shoes. One of the things in first grade that the school sent out was it'd be ideal if the kids can wear laced shoes and they could tie them. So we started this whole thing where he has to tie a lace 5 times a day. We took a lace out of my shoe and put it there. So we're having this conversation. And at the same time, my daughter, who is 2 years younger, going to kindergarten, we're not having that same conversation with them. So my son Brooks, very aptly, asked me, he's like, why do I have to worry about this when my sister doesn't? And I bring this up to make this point. Timing in life, in all aspects of our life, matters. What each of us are doing collectively matters, but also what each of us are doing individually within our own lives and in our own timelines. And the tying and the lacing that go hand in hand, I'm teaching my son, has a really good correlation to our conversation today. It's the same conversation about actively contributing and staying true to your plan and staying disciplined. What you might be doing might be different than your neighbor. Just because your neighbor is doing it doesn't mean you should be doing it or should not be doing it, right? Different context, collectively matters, but individually what we do matters. But for those who have spent many years investing, it becomes even more critical right now to understand how those investments are going to continue and what that means to you. Like my son, Brooks, who has to learn to tie his shoes. It's a big new thing for him. And for many of you, you're in different phases. You may have invested for a long time, or maybe you're just starting your career, or you're just in retirement. There's different phases that we go through in life. So there's one big thing I want to say openly here, and that is this. There is absolutely no one right answer to this question of when and how you should stay invested. And here's why. Given that the needs and wants and desires of every person listening and watching, myself included, are so vastly different, this is why when I'm meeting with clients or an advisor meets with clients, we collectively and individually have different goals and objectives with your money, with your planning, with your families, and with what you want to be doing with the stewardship that you have of the money you're making. So we need to make sure that we're not relying on generic advice, because relying on generic advice to determine the most appropriate strategies can actually be dangerous, in my opinion, and result in less than the desired outcome. And I want to bring up a few fundamental things to consider when answering this question for yourself. Number one is this: know your income score. What does that mean, Brad? Your income score is simply the percentage of your monthly expenses that are covered by predictable sources of income. Think like your paychecks right now when you're working. Maybe you have another business with an income stream, or a rental property with rental income. So for example, let me give you an example. If your monthly expenses right now are $10,000 a month, and your income amount, maybe you're in retirement through pensions or Social Security, is $8,000 a month, your income score is 80%. In this case, there is a quote unquote gap to be filled of $2,000 a month that needs to come from other sources to maintain the lifestyle you want. So you may have to sell assets when values are low. However, if your score is near or at 100%, you should know you have more flexibility to ride out the ebbs and flows of the market and be better positioned to keep that diversity in your portfolio. And here's what I want to bring up here. Your income score matters heavily because it also has a lot to do with your distribution rate. I've talked about this on this show very heavily. The distribution rate is a simple mathematical equation. It's X over Y, right? You've seen that in our algebraic questions. You know, we always make that joke, like, what is this going to do in my real life? That one actually matters. If you take that same example I have of $8,000 a month coming in and $10,000 a month going out, we have a net need of $2,000. If we take that $2,000 a month, multiply that times 12, following me, for a year, that's $24,000. If we divide that by the amount you have saved, that gives you your distribution rate. Let me give you an example. If your distribution rate, if your assets were $1 million and you have $24,000 divided by $1 million, your distribution rate is 2.4%, right? What does that mean in context? The average and sustainable number that we see each year is anywhere between 4 and 5% of a distribution rate is a very sustainable to provide longevity in retirement. If you're at 2.4, your income score being at 80% relative to your distribution rate is spot on. So it matters not just your income score, but how that also relates to your distribution. Now, if that 80% goes down to 70 or 60%, that's when you have to be a little bit more careful about how you're managing your money, and ultimately where planning comes in. This is where the rubber meets the road, as they say, right? Because if you go back to my example and your score is 60% instead of 80%, now you have a $4,000 need. 4,000 times 12 is 48,000 divided by that same number. You're at 4.8%. You're still technically within the sustainable number, but we're much higher. And remember, there's 2 4-letter words when you get to retirement. And to be clear about retirement, it means being financially free. It doesn't mean you need to be 65. You can be wherever you need to be. But to save for this is need. The 2 4-letter words are need and want. What I just described to you is your needs. But we all know we have wants. We're Americans. We want things, right? You want to be able to say, okay, I want to cover my rent and cover my mortgage. Great. I want to cover my insurances, my food. Great. But then do you want to travel? Do you want to go see grandkids? What is it you want to be doing, in retirement or when you are financially free? That's where the needs and wants come together. So your income score being number one matters. The second thing I want to bring up is understanding your investment timeframes. We're only looking at what's right here and right now in a year like 2022. We get very myopic when it comes to the volatility that we've seen. It's very normal. It's a normal psychological thing that happens to any investor. We're looking, these days are long. When you see all this red and all this volatility, days can seem really long. But the idea about understanding your time frame, I've talked about this heavily on this show, and we've talked about it a lot in our radio programs, at our dinner events, and definitely with our clients, is understanding where you are in your investment time period. Like, hey, Brad, whatever I have by the time I retire is a very common question I get, or a common statement. That's all I have going into retirement. That answer and that question is actually accurate, but let me give you an example. If you were to retire on a Friday, barring a national holiday, markets are open. And as I said often, God willing, the same amount of time you have working, you'll have in retirement. So if you've got 25 or 30 years in working in your career, hopefully you'll have 20, 25, 30 years in retirement. Now, I know there's a lot of you right now that are probably rolling your eyes saying, oh, I hope I wish that I would live that long. That's fine. Whatever the time period of life expectancy you expect matters, but know this. A lot of clients look at retirement or being financially free as a finish line. It is not. It is simply another phase that you are entering. Typically what we call, there's 3 phases in the financial life. There is your yearning, where you're learning your skills, your trade, your craft, kind of what you like in this world, what you want to be doing, hopefully finding your purpose. And that's where you focus, and you get into the accumulation phase. This is a long phase, and it could be varying of how you want to work, but the accumulation phase is where you build the wealth that you want to use in the third and final phase, which is the spending or distribution phase. When you go from working, whether you're 30 or 40 years old being financially free, or you're 65 or 70, when you go from working, the accumulation phase, to the distribution phase, it's not an end line. You're not getting called back up. You're just going into retirement, and hopefully you have the same time period to use it. So when you hear someone like me saying long-term effect, like, Brad, I'm 65 years old, I'm no longer 30. I get that, but you still have, God willing, based on life expectancy, 20, 25 years. We need to manage your retirement assets, your IRAs, your 401k with that in mind. And this is a subjective opinion, but anything in my world in terms of timing, anything in my world investment-wise and planning-wise that's less than 2 years is short-term. If it's more than 2 years, especially between 2 and 5 years in particular and beyond, I consider that long-term. So we still have to have that mindset. So just because you're retiring and not collecting a paycheck doesn't mean you get really short-term on your assets. A lot of us have heard I'll even call it the misnomer, that you should get more conservative as you get older. And I'm not saying that's right or wrong. I've brought this up on the show before. What I am saying, that context matters a lot. Like right now is a great point. When you have a rising interest rate environment, which we've definitely seen in 2022, bonds get hurt. When you have a rise of rates, your bond prices go down. Now, as you see bond or interest rates come down, you'll see bond prices go up. But just going to a safety net of bonds just because you feel like you're 65 or 70 now and all of a sudden you have to, that's not the right answer. And by the way, if you're watching this or listening to this and you're 25 or 30, know this and start putting it in your mind that that notion of getting more conservative as you get older needs to be contextualized with your plan. Now, there's probably a good chance you've heard someone tell you that your investment time horizon is short or shorter than you think. And the prudent thing to do is shift a significant portion of your assets from stocks into historically more conservative investments, like I mentioned, like maybe CDs or bonds or cash. But again, understand this, not all parts of your retirement will fall under the umbrella of a quote unquote short time horizon. As I just mentioned, the actual need for cash in the near future, 2 years, 5 years, would absolutely apply to be considered a short-term need. However, living a quarter century or more in retirement, paying for those costs of healthcare, continuing to grow a legacy that you wish to leave to your family are all still pieces to this equation that require us to consider long-term growth strategies for that portion of your wealth, which we may be comfortable keeping invested. And that comes down to diversification and active management. So those are big changes when it comes to your portfolios that are really key as you head into that time horizon conversation of knowing and understanding your various investment timeframes. And as I've shared before, and I can't tell you in the many years in this business of investing and managing and planning and putting all of these financial and wealth forecasts together, I want to reiterate this point. Time is more valuable than money. So understanding your time frames makes your money more valuable to you because you can set your goals and objectives accordingly. The third item that I want to bring up and I want to talk about is filling your buckets. Now, you've probably heard of bucket planning or the bucket strategies. I've talked about it before, short-term, mid-term, long-term buckets. It's important to understand this, and it's an important view of your wealth to look at it in its entirety. That's what holistic means. And ultimately, determine how much you will need to carve out and dictate for your short-term, your intermediate term, and your long-term needs, and then ultimately for your wants and your desires. Remember, 2 four-letter words, wants and needs. So we don't want to commingle these funds for these various needs, but instead determine how much to set aside for things such as generating needed monthly income or things like future healthcare costs. And again, like I mentioned before, for a lot of clients, legacy wishes, or maybe even again, discretionary desires, those trips you want to take, the things unseen that we can't plan for that just come up in life. Those all need to be in the right bucket. And here's what I always have said and what I want to say about planning. I know it can be boring. And it's like, here I am every week talking about how it all needs to be put together into a plan, because I said before, growth without a plan, really isn't growth at all. As you gain a better understanding of your needs through planning, you'll be in a better position to determine how much of your wealth you can subject to certain risk. Maybe it's risks or risk in the market and how much you will need to reallocate to other options, such as cash or maybe more secure income or other items like bonds or things like that. Planning, as boring as it may be, will help you alleviate some of those rules of thumb, and I'll even dare say misnomers that come out there. As soon as you hit 60 or 65, you need to go all in cash or bonds. Like, you have to really look at all this in context. I know I'm reiterating that point, but I think it's a really important one. And the fourth and final thing I want to bring up with this question today around should I stay invested during these volatile times is money activation. Now, here's what I mean by that. Get more active with your money. Get more active with your money that remains in the market. Transitioning from a quote unquote, passive money management approach to one that is more active is a great option. It's been said before, you want to go fast, go alone. You want to go far, go with a team. Now, I'm a believer in this. As I've shared many times each week, that's what we do as advisors. Passive investing is also known as the buy and hold investing. It may have worked during your 20s and 30s and 40s because it was simple, it was automatic, and quite possibly really cheap and inexpensive. I get it. However, because of the impacts of the market and the highs and the market lows, it's all felt even more as you get closer to retirement. Anyone watching or listening right now who's maybe mid-40s, mid-50s, kind of looking at retirement, it's closer to you now than it was 20 years ago, or maybe you're watching or listening right now and you're in your 60s or in retirement, you know what I'm talking about. The mind shift is different. And you hear someone like me say, okay, time period doesn't matter because it still has to have a long-term objective, but that's only one half of the story. The other half of it is, I get that, Brad, but this is all I have. If I'm going to retire, this is all I have now for the rest of my life. This is it. So consider again, this is why I want to share this in the area of getting more active with your money, is to consider hiring an advisor. It doesn't need to be me. This isn't an all roads lead to Brad Barrett or One Capital. It doesn't need to be us at all. But as you've heard me say many times for many years, I'm a big believer in counsel and advice because it does so many things, not only financially, but psychologically. It has accountability. Plus, if you find someone who's experienced and who actually sits on your side of the table, someone who actually cares about you, yes, we do exist. I consider myself one of them when it comes to the investing world. There are good people who have hearts, who are empathetic, and who really, truly want to help you. Again, it's been said, you've heard it before, if you want to go fast, go alone. If you want to go far, go with a team. Again, doesn't have to be us, but consider hiring an advisor whose approach to active management is one you can understand, one you are comfortable with. I mean, there are dozens of active philosophies and strategies out there. So you want to find an advisor who's information driven, willing to recalibrate portfolios, and really to sit with you. Now, I'll say, however, that often the data warrants the fundamental investing that happens, as I've shared many times on the Make Your Money Matter show. When you find a good position, you almost want to be right in the middle. You don't want to buy and hold and just ride and die all the way to the end, but you also don't want to actively be trading daily because you might have a position that you've researched and fundamentally and really like, and you want to see it through. So I call it actively waiting. It's, to me, a really good active management strategy, something we employ here at One Capital Management. It's about finding the good positions, dollar cost averaging through them in your investments, or doing things like drips or dividend reinvestment programs. All of those aspects, when you find the right positions, come on an active and proactive basis when it comes to managing your assets. That makes the difference in uncertain times, because these are uncertain times with no apparent end in sight. Let's be honest. So take time now to reflect on some of these principles that I've talked about today, because I think as we all collectively are going through the past, couple months and this whole year around supply chain, around all the data points and economic indicators that we talked about last week, and all these points we brought up, that's really interesting for you to talk about this volatility and really should we be staying invested. And I talk about it a lot in our planning meetings, but I wanted to share it here on the show. Everything from knowing your income to understanding your investment timeframes to filling the right buckets, short-term, mid-term, long-term, and then getting more activation out of your money, more money activation. So don't sit idle and just know that these funds are gonna get you there. This is one of those things where you wanna make sure you have the right players on your bench. That's the team you need to build. Again, I'm gonna say it again. You wanna go fast, go alone. You wanna go far, go with a team. All right, it's that time of the show to answer your questions. If you have a question or topic you'd like me to address, you can leave a comment or question in the comment section, or if it's something a bit more personal, you wanna go through it one-on-one, just go to the About page on our channel and send us an email. We always keep the emails and the questions we get here anonymous, so you never have to worry about your name being shared, but we'd love to hear from you. So the question this week came in, can you give a good example of a really good diversified portfolio and what it looks like? So I like this question. I chose this one for this reason. I think diversification, I know it's an overused term and a lot of us investment managers use it, be diversified. And what does that really mean? So let's break it down from two levels of economic perspectives. One is a bottom-up approach. The other one is a top-down approach. So either one has different strategies, different mindsets. But what that means is focusing from the bottom up, a company into an industry, into a sector, and into the macroeconomic world. The other one is the exact inverse, right? And so there's different philosophies on those, but you want to diversify within company, value, growth, middle, small, large cap companies, sectors, industries. So a lot of people don't understand this, but you've heard the terms cap, like mid cap, large cap, small cap. What does that mean? Cap stands for capitalization. So if you take the stock price of any stock you might be looking at, multiply it by the amount of shares outstanding, that gets you to what we call a market capitalization. Essentially, how big is that company's reach? Now, generically speaking, this is subjective to some extent. If that number is above 10 billion, it's considered a large capitalized company. Think value companies here, Johnson & Johnson, Pfizer in the pharmaceutical space, Bank of America, Apple, big companies, big reach, telecommunications, AT&T, Verizon. If that number, again, stock price multiplied by amount of shares outstanding, that's your market reach, is between 2 and 10 billion, it's considered a middle capitalized company. If it's between $500 million and $2 billion, it's considered small capitalized. And if it's less than $500 million, it's considered micro. So not only do you want to diversify within the sizes of the investments, but you also want to diversify internationally. We're in a big bad world nowadays. So invested just domestically won't just do it. So you want to have international exposure, international small, large, and mid cap. So I'd answer it this way. I wanted to kind of give a little bit of background on some of the things that we hear often of capitalization and sectors. You also want to look at, again, a big broad world out here. And at One Capital Management, we're a global asset manager. We manage assets across the globe because we like different areas. But for example, I may not want to pick up on a single company in a small or micro capitalized environment because the risk might be too great. But I'd like to own an ETF or a fund inside that space that allows me to get the basket of those companies. Whereas on a value company, maybe domestically, I might actually like to invest because I can see the research on a large capitalized value dividend paying company. I might own an individual company. So broad diversification really can be formed up in multi-different sectors, different industries, globally is a big one, as well as different types of investments, ETFs versus individual funds, and then, or individual stocks, I should say. And then on the fixed income side, same thing. You want to be on the bond side of environments. You want to have a good, healthy mix of equity to fixed income. And that's really what you see mostly when it comes to diversification is the allocation mix between your equities and your fixed income. Now, there's others you can add to their real estate or REITs, cash, gold, silver, commodities, oil, coffee beans, things like that. There's other things you can diversify throughout. But I think that is how on the show today, I wanted to answer the question of, can you provide what a good diversified portfolio looks like? It would encompass different sectors. It would encompass different size companies, different types of value versus growth. One of my best examples of growth used to be Apple before it became somewhat value, right? Growth company will typically take from investors, right, to be able to grow the company, grow the product, grow the company in general. When you get to a certain size or scale, Apple's a good example, you don't need to grow any further. You've created your brand, and now you want to reward investors by sharing a dividend. That's usually the distinction between a growth and a value company. So you also want to diversify within that as well. And then diversify again, as I mentioned, sectors, oil and gas, consumer staples, real estate, pharmaceuticals, banking. You want to have different areas of the environment. So again, if you have a question or a comment you'd like me to read here, you can leave it in the comments section or email us in the About page on our channel. Now, before we go, if you found anything helpful today and want to learn more, you can visit us on our website at onecapital.com or scan the QR code on the screen with your smartphone. It'll get you right there. You can also call or text us. We want to help. Listen, there's no pressure here. We don't treat people like a number. In fact, we value our relationships. It's the lifeblood of what we do. So click, call, or text us today. If you're not following us on social media, you should be. You can follow us at Make Your Money Matter. We're sharing great information on all of our social media platforms. As I often say, if you enjoy the show, share it with someone you like. And if you don't like it, share it with someone you don't like. But until next time, make your money matter.